Hi, my name is Wilkinson. I'm from Future Gen Solutions, and this week I'm going to talk about the core principles that underline the service that we provide called Wealth Plan A. As you'll recall, we discussed Wealth Plan A conceptually last week. This week we'll look at one of the key principles, which is that of cash flow management. With cash flow management, people often refer to it as budgeting, and budgeting is all well and good. And while you can do budgeting notionally on paper, the key thing about budgeting is to make sure that you have a structure that supports the budget itself. So the first thing we do with clients is actually get them to do a notional budget. And we provide that in an Excel form that you can modify. Having got the budget back, the key thing then is to actually apply the budget flows to the structure. What I've drawn today is a structure on the whiteboard which essentially gives a demonstration of how we would look at implementing cash flow. The first thing is that if you've got an existing home mortgage, we might create an offset account, because as you might be aware, the offset account allows us to reduce interest every day, and so it makes sense to drive the salary and wages for any household income earners into that account. If you haven't got a mortgage, then we create a cash management account, or what we call a hub account, and that's what we term to be above the line. See this dotted line we've drawn here? Like any business, we try and take all revenues and apply it above the line. Too many people we find work on the principle of paying themselves last. That is, money goes into a bank account, all their expenses come out of it, and what's left over is what you actually save. We work on the principle of paying yourself first, which is above the line, having all cash flows go into this account, the cash account, or in the case of having a mortgage, an offset account. From this account, we draw our fixed expenses. Fixed expenses are things which come, they might be lumpy expenses such as holidays once a year, or they might be utilities, rates, things which come on a progressive nature which you can pay by direct debit or transfer. We then work out what are the key discretionary expenses. And these discretionary expenses are where we look to pay yourself a living allowance on a weekly, fortnightly, or possibly monthly basis. And we can send that down to one working account or possibly two. 40% of Australians actually have two working accounts in households. So it's not an uncommon thing these days for a couple to have two separate working accounts. For those who have a credit card, we like to impose what we call the 7-day rule, which is essentially where if you draw a fixed expense from that credit card, or you draw a discretionary expense from that credit card, the credit card gets paid off in 7 days. The reason we work on this is because most people's recollection in terms of credit transactions is only 7 days. So for that reason, this is how we work on getting points through the card system, but at the same time making sure the debt is paid off every 7 days and it doesn't accumulate. A key point. And the last thing we look at, for people who don't have credit cards, and that's a good thing, we encourage the use of debit cards. Debit cards are great because essentially when you go to use the account, you've actually got to know how much cash is in the account at any time. And if the money isn't there, well, I guess you've got to leave things until next week. So hopefully you've got some pointers today about the cash flow management principles which underline Wealth Plan A. I'll see you next week.